Welcome everyone to a brand new explainer. Today, we're diving into what is essentially the ultimate blueprint for following the money in any business. IND AS 7, the Statement of Cash Flows. If you really want to understand the true financial reality of an entity, you absolutely have to follow the cash. And this standard, it gives us the exact rules on how to do just that. I want to kick things off by asking you a question directly from the objective of the standard itself. How do we evaluate an entity's true ability to generate cash and adapt to changing opportunities? You see, making smart economic decisions requires a rigorous evaluation of an entity's ability to generate cash and cash equivalents, plus the timing and certainty of when that cash will actually materialize. And that is exactly what this statement is designed to reveal. Okay, let's take a quick look at our roadmap for today. We'll start with an introduction to IND AS 7, move on to defining key cash terms, explore the 3 core activities, compare the direct versus indirect methods, touch on some special cash flow topics, and finally wrap up with disclosures and key takeaways. Right, let's jump straight into Section 1, Introduction to IND AS 7, covering the objective and scope. The primary objective of this standard is, and I'll quote this directly, to require the provision of information about the historical changes in cash and cash equivalents of an entity. It achieves this by mandating a statement of cash flows that categorizes all those historical movements into 3 very distinct buckets: operating, investing, and financing activities. Now, you might be wondering who actually has to follow this. Well, the short answer is absolutely everyone. Users of financial statements are keenly interested in how an entity generates and uses cash, totally regardless of the nature of the entity's activities. Whether the business is a traditional manufacturer, or even if cash is basically the product itself, like at a financial institution, entities need cash for essentially the same core reasons. They all need it to conduct operations, to pay their obligations, and of course, to provide returns to their investors. So IND AS 7 applies universally. Moving right along to Section 2, defining key cash terms, the building blocks. Before we can follow the cash, we need to know exactly what the standard considers cash. First up, cash comprises cash on hand and demand deposits. It's essentially the most direct, highly liquid asset an entity holds. Next, we have cash equivalents. These are short-term, highly liquid investments that are readily convertible to known amounts of cash, and, this is crucial, they're subject to an insignificant risk of changes in value. Usually, this means a short maturity of, say, 3 months or less from the date of acquisition. And keep in mind, equity investments are generally excluded here, unless they are in substance cash equivalents. A good example would be preference shares acquired within a short period of their maturity with a specified redemption date. Finally, cash flows are simply the inflows and outflows of cash and cash equivalents. But pay really close attention to what is excluded here. Cash flows do not include movements between items that constitute cash or cash equivalents. Why? Because moving money around these components is just part of the cash management of an entity. It's not part of its operating, investing, or financing activities. So shifting funds from a demand deposit to a short-term cash equivalent, that's just internal housekeeping, not a true cash flow activity. All right, Section 3, the 3 core activities. Tracing the journey. This is where things get really interesting. Activity number 1. Operating activities. Think of this as the primary engine of the business. These are the principal revenue-producing activities of the entity. The amount of cash flowing from operating activities is a massive indicator of whether the entity's operations generate enough cash to repay loans, maintain operating capability, pay dividends, and make new investments, all without needing external financing. This includes things like cash receipts from the sale of goods, receipts from royalties, fees, and commissions, as well as the cash payments made to suppliers and employees. Activity number 2, investing activities. This bucket covers the acquisition and disposal of long-term assets and other investments that aren't included in cash equivalents. Disclosing these separately is incredibly important because they represent the extent to which expenditures have been made for resources that are intended to generate future income and cash flows. We're talking about cash payments to acquire property, plant and equipment, intangibles, and other long-term assets, plus cash payments to acquire the equity or debt instruments of other entities. And activity number 3, financing activities. These are activities that actually change the size and composition of the contributed equity and borrowings of the entity. Why does the specific classification matter so much? Well, it's absolutely vital for predicting claims on future cash flows by the providers of capital. Examples here include cash proceeds from issuing shares, cash repayments of amounts borrowed, and cash payments by a lessee to reduce the outstanding liability relating to a finance lease. Now here's where it gets a bit tricky. A single transaction can actually have multiple classifications. For example, let's say an installment paid for an item of property, plant, and equipment acquired on a deferred payment basis includes interest. You can't just lump it all together. You have to break it down. The interest element, that gets classified under financing activities, but the loan element, that's classified under investing activities. And this brilliantly illustrates how the standard requires us to dig down and report the true nature of every cash flow. Moving on to Section 4, direct vs. indirect methods for reporting operating cash flows. So an entity has to report cash flows from operating activities using one of two methods, the direct or the indirect method. The direct method is where major classes of gross cash receipts and gross cash payments are actually disclosed outright. The indirect method, on the other hand, is where profit or loss is adjusted for the effects of non-cash transactions, deferrals, and items associated with investing or financing. Now, while both are perfectly permitted, IND AS 7 explicitly encourages entities to use the direct method. Why? Because the direct method provides information that is super useful in estimating future cash flows, information that is simply not available under the indirect method. Let's move to Section 5, Special Cash Flow Topics. This is where we handle the exceptions. Let's talk about interest and dividends, because the rules here are strict. For a financial institution, cash flows from interest paid and interest and dividends received are just classified as operating activities. Makes sense, right? However, for other, non-financial entities, IND AS 7 actually removes the options that exist in some international standards. For these other entities, interest paid must be classified as a financing activity, while interest and dividends received must be classified as investing activities. Oh, and for all entities across the board, dividends paid are always classified as financing activities because they're fundamentally a cost of obtaining financial resources. Let's run through a few more crucial rules. First, cash flows arising from taxes on income are usually classified as operating activities, unless they can be specifically identified with financing or investing activities. Second, foreign currency cash flows must be recorded by applying the exchange rate at the exact date of the cash flow. Remember, unrealized gains and losses from exchange rate changes are not cash flows. And third, non-cash transactions, like acquiring an asset through a finance lease or converting debt to equity, are completely excluded from the statement of cash flows. Because they don't actually use cash, they are disclosed elsewhere in the financial statements. There is also a very specific rule for subsidiaries. The aggregate cash flows arising from obtaining or losing control of subsidiaries or other businesses must be presented separately and classified as investing activities. Furthermore, the aggregate amount of the cash paid or received as consideration is reported in the statement net of any cash and cash equivalents that were acquired or disposed of as part of those transactions. All right, we've made it to Section 6, Disclosures and Key Takeaways. Let's wrap up this blueprint. The standard lays out several mandatory disclosures. An entity has to disclose the components of its cash and cash equivalents and present a reconciliation of those amounts with the equivalent items reported in the balance sheet. Also, an entity must disclose, along with commentary by management, the amount of any significant cash and cash equivalent balances held by the entity that are not available for use by the group. On top of that, the standard requires disclosures that enable users to evaluate changes in liabilities arising from financing activities, which includes both cash flow changes and non-cash changes. So, to summarize the ultimate significance of IND AS 7, cash flow information drastically enhances the comparability of the reporting of operating performance across different entities. Why? Because a cash-based view cuts through and eliminates the effects of using different accounting treatments for the exact same transactions and events. When you use the statement of cash flows in conjunction with the rest of the financial statements, it really enables users to evaluate the true changes in net assets, financial structure, liquidity, and solvency. I want to leave you with this incredibly powerful quote straight from the standard. Historical cash flow information is often used as an indicator of the amount, timing, and certainty of future cash flows. It's also super useful in checking the accuracy of past assessments. Ultimately, understanding exactly how cash moved in the past is the single best key to unlocking and predicting a company's financial future. Thank you so much for joining me on this explainer of IND AS 7, and keep following the cash.